Across 2025 and 2026, the largest Western energy producers assumed a defensive posture. Companies like BP and Total Energies actively pulled back from expansion. Their prevailing mandate is capital discipline. To repair their balance sheets and return cash to shareholders, these firms are halting stock buybacks and selling off stakes in pipelines and storage facilities. But while Western majors retreat, the Abu Dhabi National Oil Company is moving in the opposite direction. Backed by sovereign wealth, ADNOC is aggressively buying up international assets. While Western majors shrink investments, ADNOC maintains a sustained spending plan of $150 billion through 2030. And that excludes XRG, their international investment arm, whose enterprise valuation grew from $80 billion to over $150 billion within a year. Abu Dhabi is using state-backed capital to acquire the specific infrastructure and production capacity that listed majors are pruning, centralizing a larger share of the world's gas and polymers under its control. ADNOC's leadership explicitly points to three forces driving this strategy: the broader energy transition, the industrialization of emerging economies, and the sudden, massive power requirements of artificial intelligence. To capture that demand, XRG is building a global natural gas platform. They are taking and expanding ownership stakes in major projects like the Rio Grande LNG facility in Texas. The logic tying a Middle Eastern oil company to American tech infrastructure comes down to physics. Artificial intelligence requires massive server farms to run, and those server farms require a staggering amount of electricity. By investing directly in Texas LNG, XRG is buying into the physical supply chain that moves natural gas from the extraction field directly to the end user. They are securing a long-term position as the field provider for American data center demand. In ADNOC's thesis, gas serves as both a lower carbon transition fuel and the mandatory physical power bridge required to sustain the next computing cycle. The second half of XRG's global architecture focuses on what happens after those hydrocarbons leave the ground. They are moving downstream into manufacturing the high-value materials those raw resources become. By owning the facilities that produce specialized polymers and plastics, a producer can capture significantly higher profit margins. It also insulates their balance sheet from the volatility of crude oil prices. The scale of this downstream push is massive. XRG recently completed an acquisition of Covestro, a major German manufacturer of high-performance polymers. Following that, they executed a massive consolidation play. By combining Borouge, Borealis, and Nova Chemicals, they formed Borouge International, creating a specialized polyolefins group valued at roughly $60 billion. If gas serves as the bridge to meet new electricity demands, these chemicals acquisitions are the final destination. ADNOC is securing its position as a fully vertically integrated, top-tier global chemicals producer. These acquisitions have transformed ADNOC into a global conglomerate, giving Abu Dhabi direct influence over international pricing and supply for both natural gas and polymers. For business-to-business suppliers, this shift is highly practical. ADNOC now represents the most dependable, large-ticket procurement pipeline in the entire energy sector. This radar chart plots expanding vendor markets. Instead of just traditional upstream operations, suppliers can now bid on massive zones covering international gas, chemicals, and lower carbon energy. But accessing this budget requires passing strict qualification gates, in-country value rules, local hiring, and technical ESG standards. As traditional Western energy budgets contract, the capital is moving east. For the global supply chain, securing future revenue requires immediately aligning their services with the industry's largest, most aggressive $150 billion expansion plan.